Welcome to the second episode of our podcast here at HML Investments. My name is Joel Rangel. I've been in this industry for about 8 years. Started with HUD products, which are FHA, VA, and I've also done conventional and Fannie Freddie and so forth. That's my introduction. Eric?
Yeah, my name is Eric Wall. I'm in year 2 in the business. This is Funded Fridays, our weekly podcast on loans, lending, all things mortgage and real estate, and just excited to jump into it. So, Joel, what you been working on recently?
Well, just recently we funded a couple loans. One was a DSCR loan, which was actually a little troublesome, but we got it done through creative means. DSCR, in case anybody doesn't know, it's a loan that's based on rental income on investment properties. So the client can't live in their property. It has to be rented to tenants. So a rental loan is generally based on the rent that it receives. And as long as the rent is more than the mortgage payment, generally that's a qualifier for a DSCR loan because there's no income requirements. We don't ask for tax returns, W-2s, pay stubs, anything to that effect. Really easy loan to do. We just recently got that done, and I also just funded almost $1 million construction loan in Florida, which is 2 single-family residence builds from the ground up. They were under contract for the land. They needed to close fast because we actually got better terms than the lender that they were going to go with.
Great work, Joel. Yeah, and for anyone that doesn't know, DSCR, the acronym itself, stands for Debt Service Coverage Ratio. As Joel was alluding to, all you need there, which is what makes it so simple, is to see that the income from the property generated can take care of the payment monthly that the mortgage would have for you. So great work there on those loans, Joel. Recently, I just funded a mid-construction project, in Florida. Very qualified builder. 17 builds on his track record. He essentially owns a peninsula all to himself of land, which is super cool. And he had an interesting scenario where he was building a home custom for a client, and the client was a little older, decided he didn't have the patience to wait for the completion of the home. So he went out on a random weekend, purchased a different completed home, and left my client with a mid-construction project. But we just lent him the last $900,000 he needed. To finish it up, he had put $400,000 in already, and he thinks he can sell it for $2 million. So still a nice profit there for him. And working on submitting the second deal for that borrower right now as well. And then I also recently just got approved, hoping to fund either tomorrow or beginning of next week, a $3.8 million phase 1 development of 20 townhomes in San Diego, California. Similarly, super qualified builder. He's been winning awards in the county of San Diego over the last 15 years for custom and spec homes and his developments. It's a really exciting project that is in an opportunity zone, so kind of a unique scenario there that has some tax benefits for him. But yeah, those are my 2 most recent ones, and I'm trying to get into more DSCR loans myself.
Can you describe any kind of challenges or anything you had to overcome with your products?
Yeah. The insurance issues in Florida, and huge, like just the skyrocketing rates and inconsistencies from loan to loan has been creating a lot of headaches in the world of insurance, and developers aren't excited to pay those increasing rates. So we had just a lot of back and forth hunting for quotes to get my developer's loan in Florida approved from the insurance standpoint. It literally took over 2 weeks, which normally isn't the case. Normally we get the quote, they're good to go, same day, next day. But that insurance is really a headache. What about you?
Yeah, that's happening more and more throughout the country. Insurance companies are pulling out of states, not even offering new policies, just straight cutting it out, just basically honoring the existing policies they have. And then when that expires, they're moving out. Yeah. They're not even offering new policies in certain areas. Happening a lot in Florida, California, especially in California. It's we do have contacts that can help out, but yeah, a lot of insurance companies are pulling out. We find that's a big problem.
Yeah, well, a lot of times the clients are insistent that they want to go with their insurance person. They know they've worked with in the past, but sometimes that insurance person isn't hip to all the changing policies and is not as utilitarian, not as useful at getting things accomplished, even though they have an existing relationship, which is why we always recommend going with our third-party carrier. But looking towards the market, Joel, what do you see from the investor standpoint, from how people are feeling about prices, interest rates? You have any projections?
Yeah, that's a good question. A lot of people are anticipating the Fed to cut rates. But a lot of lenders out there are also anticipating it, and they want everybody to invest now. So they've actually anticipated those cuts and dropped their rates accordingly. Have you seen that as well?
Yeah, I've seen that. And, a lot of people are, from the investor perspective, clients are coming to us saying, hey, I'm thinking about maybe waiting because they've heard about
don't wait, folks.
Rate cuts. But that's our advice is don't wait because lenders have already adjusted their rates, like Joel was alluding to, and dropped prices accordingly in anticipation of that happening from the Fed. So you're not guaranteed, by waiting another month to 3 months that you are actually going to find a cheaper rate. Best to lock it in now where it is.
Absolutely. Absolutely. And one thing everybody needs to keep in mind, especially when you have certain properties that you want to look at and you anticipate and you want to wait, guess what, folks? You're not the only person waiting.
Yeah.
So as soon as those rates drop officially, you're going to have a bidding war.
That's right.
Right?
That's right. Yeah. And not every single rate drop from the Fed even necessarily affects all types of loans. Right. The federal funds rate, the Treasury notes, all those high-end financial, relationships between banking, the banking industry and the Federal Reserve have different effects from lender to lender. So you're not even necessarily going to see them, this happened, and then as a result of that, here's an obvious change. Like Joel said, it's best to lock it in now if you can get a hold of a rate that makes sense for your deal and your profit's still there.
Right. Yeah, definitely, guys, get your homes now. Get your homes now, because in an ideal situation when everything is in a utopian society and everything is exactly where you want it to be, you're not the only one shopping. Yeah. Right? And there's going to be someone who might even have more money than you that can outbid you. Definitely. Just because they got that lower rate.
And one more thought for you, Joel. Where are you looking for deals mostly right now, or where are you finding the most consistent deals? What states, markets are you trying to focus on?
Well, that's a great question. Markets come and go, right? Back in the early 2000s, Colorado was a hot market. People were moving there. People wanted to invest there. And of course, Texas and Florida are mainstays. They're pretty good. Also, we're seeing a lot of scenarios, a lot of deals in Tennessee and South Carolina. Are you seeing the same thing?
Yeah, I was going to say the Carolinas have been really hot recently. I've been seeing a lot of deals in North Carolina, South Carolina. Florida's still hot, even with the insurance issues. Texas is still good, although Tennessee was one I was seeing much more activity out of last year and the year prior, and has cooled down a little bit, in my opinion. There, people just being less aggressive with the leverage they're willing to offer.
Right, and it's not just Nashville.
Of course.
Right? You can do the outlying cities, Chattanooga, a lot of lenders don't like to lend in rural areas per se, but you have the smaller cities that have a decent population that we can work with that are actually growing. Not just the capital cities, not just the mainstays. Yeah. So that's something to take a look at too.
Definitely. Great advice there. Thank you everyone for tuning in to Fund It Fridays. Really appreciate your support. If you got value out of this video, give us a like, give us a subscribe, and we'll catch you next week.
Yeah, this is Joel.
This is Eric, signing off.